Let me ask you a simple question. What if I told you that one 3-digit number decides how expensive your life is going to be in America? Not your salary, not your education, not how hard you work. One number. This number decides whether you get approved or denied, whether you pay low interest or high interest, whether you rent an apartment easily or struggle, whether you build wealth or stay stuck paying more than everyone else. That number is your credit score. And here's the problem. Most people use credit every single day, but they don't actually understand how credit works. Today, I'm going to change that. By the end of this video, you'll understand what a credit score really is, how it's calculated, why it matters more than you think, and how to use it as a tool instead of letting it control you. This is not theory. This is real life in America. Let's begin. A credit score is not a measure of how rich you are. It's not a measure of intelligence. And it's definitely not a measure of your value as a person. A credit score is a risk score. It answers one simple question for banks, lenders, landlords, and even employers. How likely is this person to pay back money on time? That's it. When you borrow money, the lender is taking a risk. Your credit score tells them how safe or how risky you are. Higher score means lower risk. Lower score means higher risk. And in America, risk has a price. Low risk, you pay less. High risk, you pay more. That's how the system works. In many countries, credit is optional. In the United States, credit is infrastructure. Your credit score affects car loans, mortgages, credit cards, apartment rentals, insurance rates, and sometimes even job applications. Two people can earn the same income, live in the same city, buy the same car, and one of them will pay tens of thousands of dollars more over their lifetime. Why? Credit score. That's why understanding credit isn't optional in America. It's survival knowledge. In the US, your credit information is tracked by 3 major companies: Experian, Equifax, and TransUnion. They collect data about how you use credit, and they create reports based on your behavior. Your credit score is calculated from those reports. Important to understand, your score may be slightly different at each bureau. That's normal. What matters is the behavior behind the number. There are many credit scoring models, but 2 matter the most. The first one is the FICO score. This is the most important score. About 90% of lenders use it. The second is Vantage score. You often see it on free apps. If you care about real approvals, real loans, real interest rates, FICO is the one that matters most. Credit scores range from 300 to 850. Here's what those ranges really mean. Scores below 580 are considered poor. 580 to 669 is fair. 670 to 739 is good. 740 to 799 is very good. And 800 and above is excellent. Here's something most people don't know. You don't need an 850. Once you reach the mid-700s, you already qualify for the best rates. The real goal is not perfection. The real goal is control. Your credit score is calculated using 5 factors. If you understand these, you can predict how your score will move. The most important factor is payment history. This alone makes up about 35% of your score. Do you pay your bills on time? Late payments hurt. Missed payments hurt more. Collections hurt the most. One late payment can stay on your report for up to 7 years. So rule number 1 of credit is simple. Never miss a payment. Ever. The second factor is credit utilization. This is where most people destroy their score without realizing it. Credit utilization means how much credit you're using compared to how much credit you have. If your credit limit is $10,000 and you're using $5,000, that's 50% utilization. That's bad. The golden rule is this: keep your utilization under 30%. Under 10% is even better. High utilization makes you look risky, even if you pay on time. The third factor is length of credit history. This measures how long you've been using credit. Older accounts help your score. New accounts lower the average age. This is why closing old credit cards can hurt your credit, even if you don't use them. Time matters in credit. The fourth factor is credit mix. This looks at the types of credit you have: credit cards, auto loans, mortgages, student loans. You don't need everything, but a healthy mix helps. The fifth factor is new credit inquiries. Every time you apply for credit, a hard inquiry is added. Too many inquiries in a short time signal risk. Applying impulsively can drop your score quickly. There are a few myths that keep people stuck with bad credit. Carrying a balance does not help your score. Paying interest is not required. Closing cards does not improve your score. It often hurts it. You do not need debt to build credit. You need responsible use. And your income has nothing to do with your credit score. Credit is not free money. Credit is not income. Credit is a tool. Used correctly, it saves you money. Used emotionally, it traps you. The wealthy don't avoid credit. They control it. Now let's get practical. One of the biggest mistakes people make with credit is ignoring it until something goes wrong. You should never guess your credit score. You should know it. In the United States, you are legally allowed to check your credit reports for free. There is one official website you should know: annualcreditreport.com. This is the government-authorized site where you can view your credit reports from all three bureaus: Experian, Equifax, and TransUnion. You may not always see your exact FICO score there, but you will see the information that creates it. And that information matters more than the number itself. You should check your credit reports at least once a year, ideally every 3 to 4 months. Why? Because credit report errors are common, and errors cost money. Many Americans have mistakes on their credit reports without knowing it. Accounts that don't belong to them, incorrect balances, late payments that were actually paid on time, debts that should have been removed years ago. If you don't check your credit, you're letting mistakes control your financial life, and fixing an error can raise your score without spending a single dollar. That's free progress. If you find an error, you have the right to dispute it. Each credit bureau allows disputes online, by mail, or by phone. Once you file a dispute, the bureau usually has about 30 days to investigate. If the lender cannot verify the information, it must be removed. This is why monitoring your credit is power. Now let's talk about how to improve a low credit score. This is what most people really care about. There is no magic trick, but there is a system. First, pay everything on time. This is non-negotiable. Set up automatic payments, even if it's just the minimum. One late payment can undo months of progress. Second, lower your credit utilization. This is one of the fastest ways to see improvement. If your cards are close to maxed out, pay them down. If possible, request a credit limit increase, but do not increase your spending. Lower utilization equals a higher score. Third, stop applying for new credit. Every unnecessary application slows your recovery. Pause. Stabilize. Fourth, keep old accounts open. Length of credit history matters. If a card has no annual fee, keeping it open helps your score. Fifth, be patient and consistent. Credit improvement is boring, and boring works. How long does it take to build good credit? That depends on where you start. Small improvements can happen in 30 to 60 days. Major rebuilds often take 6 to 18 months. Excellent credit is built over years. The key is momentum. Once you stop damaging your credit, it begins to heal itself. Now let's clear up an important confusion. A good credit score does not mean you should carry debt. You don't build wealth by owing money. You build wealth by using credit strategically, paying less interest, and keeping flexibility. The goal is access, not dependency. Here's how financially disciplined people think about credit. They ask, does this lower my cost of money? Does this increase my options? Does this protect my cash flow? They do not ask, can I afford the monthly payment? That question traps people. Credit score is not the finish line. It's a tool. Good credit helps you qualify for better opportunities, reduce expenses, and keep more of your money. Bad credit forces you to overpay, delay goals, and live with stress. The difference compounds over time. Most people don't fail with credit because they're bad with math. They fail because they never learn the rules. They react instead of plan. They use credit emotionally. They learn too late. Your credit score is not a judgment of who you are. It reflects habits, discipline, and consistency. And habits can change. Remember these simple rules. Pay on time. Keep utilization low. Don't apply impulsively. Check your reports. Think long term. Do this, and your credit will work for you, not against you. Let me leave you with this. In America, money is expensive if you don't understand credit, and affordable if you do. A credit score won't make you rich, but ignoring it can keep you poor. Learn the system, respect the system, use the system, and you give yourself an unfair advantage. If this helped you, ask yourself one question right now. Do you know your credit score today? And if you don't, now you know exactly where to start. Paying interest is not required. Closing cards does not improve your score. It often hurts it. You do not need debt to build credit. You need responsible use. And your income has nothing to do with your credit score. Credit is not free money. Credit is not income. Credit is a tool. Used correctly, it saves you money. Used emotionally, it traps you. The wealthy don't avoid credit, they control it.